Hi everyone, welcome to EXP Decode. In today's episode, we simplify the concept of tax depreciation, which is a powerful tool businesses use to manage their assets and optimize taxes. So, depreciation basically spreads the cost of your assets over their useful life, matching tax benefits with the period the asset is actually used. There are accelerated methods that help reduce taxable income and free up your cash for operations or expansion. Same asset, two values. Accounting and tax depreciation treat them very differently. Accounting depreciation reflects the actual wear and tear of assets in your books. Accounting methods like straight line may be used purely for reporting purposes, whereas tax depreciation is guided by IRS rules, uses makers to allow faster deduction in the early years, optimizing your tax position. What is a depreciable property? Tangible business assets, including machinery, vehicles, office furniture, certain computer softwares, and land improvements, are generally eligible for depreciation, whereas intangible assets, personal use items, and land itself cannot be depreciated. There are different types of properties. One, real property, which are immovable property permanently attached to land, for example, buildings. Second, personal property. These are tangible, movable properties, for example, machinery, vehicles. So the real property and the personal property are depreciable. The third category is intangible property, which includes patents, copyrights, and trademarks. These are not depreciable but can be amortized. Now the question is, when does depreciation begin and end? So the depreciation begins when the asset is placed in service and it is ready and available for use, even though the actual use is not required. And the depreciation ends when the cost is fully recovered or the asset is sold, scrapped, or destroyed. Now, what is the basis of depreciable property? So, the basis of depreciable property, when you take the total cost of the property and all the related expenses that are done to acquire that property. Makers under the IRS is the modified accelerated cost recovery system, which is the standard method for tax depreciation used for most of the properties. Calculating depreciation under makers involves a few key steps. We'll break them down in our next episode, so stay tuned.